Now let's talk about the portfolio management process. So here we will have three broad steps: planning, execution, and feedback. Again, this material is covered in a lot of detail in CFA level 3. Here we are just getting an overview. So imagine you are an investment advisor and you are meeting your client. In step 1, we are basically planning what the portfolio needs to look like. And clearly, to do the planning, you must first analyze the investor's objectives and constraints. So if your investor is a young person who will retire after 30 years and has a decent income, obviously the return objectives, the risk objectives, and the constraints are going to be different relative to an investor who is retiring next year. So you need to analyze the objectives and constraints and then create one of the most important documents in portfolio management, which is called the investor policy statement, or generally referred to as the IPS. So this basically documents the investor's objectives and constraints. There is a lot more to it, but for simplicity now let's just go with the fact that this basically documents objectives and constraints. Step 2 then is execution, where we first do asset allocation. In asset allocation, what we are essentially doing is, based on the investor's objectives and constraints, we say that, let's say that for $100, every $100 the investor has, we need to figure out how much to allocate to stocks, bonds, and maybe there are various other kinds of assets. Let's just say that in this particular case we are going to distribute between stocks, bonds, and commodities. So we might say that for a young investor we might put 80% of his money, of his investment, in stocks, let's say 15% in bonds, and 5% in commodities. So this is referred to as the asset allocation. Then the next step, the next sub-step is security analysis. So let's take the 80% that we have in stocks. Then we need to analyze various securities and figure out which particular stocks or securities to buy under the stock asset class, which particular bonds to buy here, and which commodities or which commodity related funds to invest in. So that's security analysis. And then we actually construct the portfolio. So once we know what we need to buy for the investor, we then actually go construct the portfolio, which means that we actually then buy these assets or invest in these assets. So that's the execution process. And then we have the feedback process, where we monitor and rebalance. Monitor and rebalance means that essentially we are doing two things. A, we are monitoring what's happening to the investor's portfolio and his investments. Second, we are also looking at whether the investor's own circumstances have changed. Now, let's talk first about what's happening to the investments. There are several things that can happen here. Let's say that the stock market is doing really well. So if we are in Pakistan in 2009, the stock market does really well. When the stock market does really well, maybe the stock market now, in the investor's portfolio, the stocks have become 86% of his overall portfolio. As long as we are sticking to the original asset allocation, what we now need to do from a rebalancing perspective is sell some stock and maybe buy more bonds and commodities, so we come back to our planned or strategic asset allocation. What else might happen? We might market situation might change, and we might feel that rather than going with these shares that we had originally, we might want to sell some of these shares and buy some other shares. So that's all part of monitoring and rebalancing. Another scenario might be that the situation of the investor has changed. So let's say he had an accident, cannot work for the next few years. So clearly that would mean that the asset allocation possibly needs to change. So we invest more in income producing stocks and bonds. So all this happens only if you are constantly monitoring and rebalancing the portfolio. Measurement and reporting means that on a periodic basis, typically at least every month, the investment manager is looking at what sort of returns are coming through, what the value of the overall portfolio is, and so on, and reporting this to the investor. So the investor knows what's going on with his portfolio. So all this is put rather simplistically, and again I feel that at level 1 this is fundamentally what you need to know. Later on in level 3 we will talk about this in a lot more detail. Pooled investments. So now we are changing gears slightly. We are talking about pooled investments, which means that investors are putting their money together into a large pool, and then this pool is being invested. So there are, broadly speaking, 4 kinds of pooled investments that you need to be aware of: mutual funds, separately managed accounts, hedge funds, and private equity funds. On this slide, all I'm sharing is that mutual funds investments can take place with a relatively small investment. Even a $50 investment can get you going with a mutual fund. Separately managed accounts require at least 100,000 investment typically, as in these are just rough numbers and can vary from place to place. Hedge funds typically require very high investments, and so do private equity funds. Let us now talk about these in a little more detail. First, mutual funds, and here again as a disclaimer, I am going to just talk about mutual funds briefly here because these are covered in more detail when we do alternative investments. But what you need to know about a mutual fund is the following. With a mutual fund, you have several small investors. Let's say they don't have enough money to create diversified portfolios of their own. So you have all these small investors who share their money or give their money to a fund manager. So this fund manager collects all the money from various small investors, and then he creates a mutual fund. So this mutual fund is the fund where all this money is collected and investments are made with this money. So if you have like 100 investors each with $1,000, then creating a diversified portfolio with $1,000 is difficult. But collectively we now have 100 times 1,000, which is equal to 100,000, and it is possible to have a diversified portfolio with $100,000. There are many types of funds. So mutual funds when a mutual fund is created, the mutual fund manager needs to define what sort of a fund it is so that investors know where they are putting their money. A money market fund will generally invest in short-term securities such as T-bills, and the point here being that an investor knows that his money is invested in liquid securities which will offer a small return, but the riskiness is low. A bond mutual fund would mean all the money is invested in bonds of various securities. A stock mutual fund means that the money is invested in the stock market. So clearly the riskiness is a little higher than the bond market and obviously much higher than a money market. Index fund would mean that the mutual fund manager is simply saying that all the money is being invested based on an index. So if we have a mutual fund based on the KSE 100, that means that all the money that is collected is simply invested in stocks that are on the KSE, Karachi Stock Exchange 100. Again, more on this when we do alt. But I also want to just illustrate 2 other important terms. Open-end versus closed-end fund. An open-end fund is one where even after the initial creation, if more investors want to join in and join this fund, they can. So additional money can keep coming in, so the mutual fund can keep growing. And since people can keep coming in, we call this fund a open-end fund. Most funds in Pakistan today are actually open-end funds. closed-end fund is where once the initial investments are made, so let's say a fund initially raises a million rupees from, let's say a fund issues let's say 10,000 shares for 100 rupees each and raises a million rupees. Now with a closed-end fund, the fund issues issues these million shares, and then once these million shares have been issued, no new shares are issued. That means additional funds are not accepted. So this is a closed-end fund, because once the 10,000 shares are issued, no new shares are issued. So if an investor invests in this one unit, which is typically what a share of the mutual fund is called. So if an investor invests in this unit, let's say he pays 100 rupees for it initially. If the fund does really well, this share price will go up, and these shares essentially trade in the stock market like any other share. So for a fund that's doing well, this share price will go up. For a fund that's not doing well, this share price is going down. So how does an investor redeem or get his money back? He does so by selling this unit to another investor. The next concept is that of net asset value. The net asset value for a fund is equal to the total value of the assets, which are typically the underlying stocks or bonds or whatever investments the fund has made, minus the liabilities divided by the number of shares. So that will give us the net asset value per share. For an open-end fund, typically the value of each share in the market will closely track net asset value. For closed-end funds, the value of the share does not necessarily track net asset value, and we'll talk about this in more detail when we cover this topic under alternative investments. The final point on this slide related to mutual funds is the concept of active versus passive funds. In an active fund, the mutual fund manager is constantly trying to buy and sell securities so as to invest in the ones that are likely to give the highest gains. So this is called active because the fund manager is very active, looking for the best buys in the market. A passive fund would be typically an index fund, where the fund manager simply says that I'm going to invest in the shares on the Karachi Stock Exchange 100, KSE 100. So he doesn't need to go looking for undervalued stocks that he expects will perform well. He simply invests in the KSE 100, and clearly he does not need to do too much work here. Exchange traded funds, again we'll discuss this in a lot more detail when we do alternative investments, but let's just get an overview here. Exchange traded funds have become extremely popular over the last 10-15 years, especially in the US and Europe. So let's just talk about what they are. So at a high level, they are somewhat similar to mutual funds, but they are also different. So let's see. How are exchange traded funds created? The basic procedure is that you have a fund sponsor. So a fund sponsor identifies a basket of shares. So let's say that a fund sponsor defines that he is going to invest in the KSE 30. So he identifies the 30 shares that he will invest in. The investor then buys those shares and gives them to the fund sponsor. So this is the fund sponsor. He's identified the shares, the investor buys them and gives them to the fund sponsor, and in return the fund sponsor issues these exchange traded fund or EF exchange traded fund. So he gives these EFT units to the investor. Now these EFT units then trade like a closed-end fund. So if you recall from my previous slide, the shares of a exchange traded fund or the shares of a closed-end fund simply trade like any other shares on the stock market. So they can go up, go down, they can be bought or sold during the trading day. So like a closed-end fund, the shares can trade all day long. Like a open-end fund, the exchange traded fund units can generally retain their value close to the net asset value. While not always, but typically exchange traded funds are, so these are typically based on a index. So that's why they are called exchange traded funds. So anyway, they typically trade like a index. Lately, however, several new innovations have been introduced, but from our CFA level 1 perspective, I think it's fair to say that most exchange traded funds trade like are like index funds. Expenses are generally low relative to mutual funds, so just take this as a given, and the tax treatment is also generally more favorable relative to mutual funds. There is a lot more to this, and if you feel that you've not understood exchange traded funds 100%, that would be totally okay at this stage. Just understand these or just remember these general points, and I will explain these in a lot more detail when I do alternative investments. Other pooled investments, so separately managed accounts. This is where you have a rich investor. Let's say that he has $200,000 to invest. The point being that he gives the investment manager these $200,000, and the investment manager creates an account specially for the rich investor and invests on his behalf. So the key point here is that the individual investor owns the shares, or the rich investor owns the shares. So even though the investment manager is buying the shares, but he is buying them on behalf of the investor, and this generally requires a high minimum investment. So if you just have $200 to invest, it makes no sense to create a separately managed account. Hedge funds, so again much more detail on this when we do alternative investments, but hedge funds basically seek absolute returns. So core point being that most mutual funds and separately managed accounts are long only, which means that these investments are so investments here are made where you buy a stock. Long means buying something. So when you are buying stocks and bonds, then you can only make money when the stock market is going up or the bond market is going up. With hedge funds, the hedge fund manager is seeking absolute return. So he even tries to make money when the stock market is going down or when the bond market is going down. How does he do that? So in hedge funds, there is a lot more complexity. The hedge fund manager might do a lot of short transactions. He might use derivatives. So do whatever is necessary to try and make absolute returns. By absolute returns, we mean that even if the market is going down, if the market is going down by 10% and a separately managed account just goes down by 5%, we look at the performance of this relative to the market and say that this account or this fund manager has done well, because even though the investment went down, but it still did better than the market. Whereas with a hedge fund, we do not compare with the market. We just look at absolute returns. Hedge funds typically use a lot of leverage, which means that they borrow money to make a lot of use of borrowed money. As mentioned earlier, these can be fairly complex. Hedge funds use several different strategies, like you will have a market neutral strategy where the fund manager has gone both long and short, and there are other strategies that involve excessive leverage. So again, these are mentioned briefly in the curriculum under this heading, but talked about in more detail in alternative investments. So I will talk about these in more detail later. And as mentioned, key is to seek absolute returns. So that's your hedge fund. Then finally we have buyout funds and VC funds. So let's talk about these on the next slide. So collectively these are referred to as private equity. A buyout fund simply is as follows, and a good example of a buyout fund in our part of the world is Abraj Capital. So what do these guys do? So from rich investors they collect money. So let's say that this is our buyout fund. So this buyout fund will then invest the money in so buyout fund will invest the money in companies. So all the money collected over here is then invested. Let's say that you have this company A, company B that is not doing very well. So what the buyout fund will do is it will buy out company A by taking some of the money from the investor fund, and plus the buyout fund will also use a lot of borrowed money to buy company A, and then the fund managers will put its own people to run this company and improve this company. The cash flow generated from this company, then typically these are companies that are already established and running and producing cash or producing some earnings. So this company is then run much better or more efficiently, and the cash that is generated through the operation is used to pay off the debt. And over time, as this company is improved to a level where the stock price has gone up a lot, or whatever criteria of success have been met, then this company is sold off at a much higher price and the returns are given back to the investors. So this is done with a whole portfolio of different companies. Key point with a buyout fund is that money is invested in established companies. At times these might be publicly traded companies where the buyout fund is actually taking publicly traded companies, buying all the shares and turning them into private companies, and then improving those private companies and then potentially reselling them at a higher price so that investors get a huge return. Venture capital or VC funds again involve working with a VC fund. So money is collected from investors for this VC fund. This fund is then, or money is then invested in small startups. So the VC fund gives money to the startups, helps these startups grow their business, and when a startup is successful, maybe the startup goes public at a decent valuation. So at that point the VC fund cashes out. So maybe let's say that a VC fund owns 50% of a given startup and made an investment of 1 million. When this startup does well, let's say that the total value of this startup is 50 million. So this startup, when it goes public or is sold for 50 million, 50% of it belongs to the VC, who makes 25 million, and that money is then paid back to the investors. So as long as the startup does well, investors can make a tremendous amount of money. More on this again when we do alternative investments. So that is it for now. As always, practice very hard. This was an overview reading, so if you get the feeling that you haven't understood all the concepts very well, that's fine, because at this stage you are just getting an overview and a general idea. But nevertheless, practice all the questions that you can find in the curriculum or in your study notes. Post your comments on YouTube related to this video if you have any, and if you like this video, just click on the like button. Thank you.